Welcome to Harvest Financial Advisors Quarterly Update. I'm Marc Henn, CEO and founder, and this video update is for the quarter ending September 30th, 2024. In this update, we will review current market and economic conditions, the change in the Federal Reserve's stance on its fight against inflation, and what we see for the upcoming election and beyond. As we head full steam into harvest time, and as I have shared in the past, I usually try and grow something that is not supposed to grow well in our region. Last year was ginger, and the year before that was a fig tree, which is still thriving as it produced around 200 figs this year and still counting. This year was turmeric. Turmeric is a tropical rhizome like ginger and needs a specific environment for it to mature, not unlike the stock market. I will share pictures in my quarterly update in January, but the turmeric appears to be flourishing. At the close of the third quarter, we find the markets flourishing at this point, with the three main indices trading at or near all-time highs. As the Federal Reserve's multi-year battle with inflation shifts to easing, we experienced the first rate cut since the Fed began raising rates in March of 2022. As we have noted and remarked in the past, the economy is still showing signs of resiliency even with current economic data. The leading economic indicators are, quite honestly, difficult to read at this point. We can still look at the government and Fed COVID-era responses and their impact on supply chains and excess savings. Indicators that were showing hopeful signs earlier this year have lost steam. Basically, in some areas we see signs of growth, and in some areas we see signs of struggle. We certainly have seen a long cycle in the industrial area of the economy where it seems it just does not want to give up, albeit it is probably in a slight downward trend. Retail sales, while experiencing slowing growth, surprise us still with signs that it has a fight left within it as consumer credit balances rise to the highest levels on record since the Federal Reserve began tracking in 1999. Now, when taken by itself, this can sound problematic. However, as a percentage of earnings, credit card debt levels have been higher in the past. With the election coming up in a month, many have been asking what impact this will have on markets. Typically, elections and government policy have little short-term impact, but can have a larger impact over years, particularly when it involves policies around taxation and tariffs. We expect this historical pattern to continue while recognizing that investors have more cash on the sidelines, in no small part due to higher interest rates. We may see some of this cash return to the markets after the election is decided. In summary, it appears that we're heading for the unusually elusive economic soft landing. And between the Fed's interest rate cuts and the diminished possibility for a mild recession, investors are increasingly optimistic. This goes a long way to explaining the current market highs. The economic outlook for the fourth quarter of 2024 appears to be one of steady, albeit slowing growth. U.S. GDP growth is expected to hover around 2%, which is close to its long-term trend rate. This moderate expansion is supported by resilient consumer spending, though signs of softening demand are present, as we mentioned, due to the depletion of pandemic-era savings and higher borrowing costs. With expectations of additional interest rate cuts and the current economic cycle in which we find ourselves, we expect to see demand pick up and the economy begin expanding in mid-2025. Markets will be looking for confirmation of this and are currently at levels which would support the view that we will not have a moderate or deep recession. We do see market headwinds, including global economic uncertainty in areas like China and Europe, corporate earnings pressure as they navigate higher input costs and slowing demand, and geopolitical tensions in hotspots such as Ukraine and the Middle East. While this is not uncommon, higher market volatility could return as it did earlier this year. In the harvest portfolios, our equity mix continues to perform well in both up and volatile markets. In addition, our adjustments to fixed income earlier this year also appear to have been timely as interest rates have now begun to fall. Cash flow within the portfolios continues to remain strong, and this will continue to be welcomed by those taking distributions in retirement. In closing, we reviewed current market and economic conditions, the change in the Federal Reserve's stance on its fight against inflation, and what we see for the upcoming election and future economic and market conditions. If you have any questions, please do not hesitate to contact our office, and as always, we thank you for your trust.